let's just summarize the material thus far. So we had the orientation in Chapter 1, just discussing sources of authority. You have Chapter 2, concepts of gross income, Section 61. We got our first look at imputed income, Supreme Court case covering the independent life insurance company. Chapter 3, we dealt with issues pertaining to what's excludable. We saw exclusion for gifts and inheritances. We got the authors are just trying to give you a foundation. So you saw that we have Code Section 102, 102A, but then we have an exception in the form of 102C. Then we have an exception to the exception. And the code sort of follows that paradigm on and off, right? Where you have a general rule, you have exception, you have exception to exception, all those things. Chapter 4 deals with employee benefits and exclusions for certain fringe benefits. Those are found in Code Section 132, and they delineate the specific exclusions that we see is often augmented by other code sections as well. So when I say augmented, meaning it extends to spouses and dependent others and things like that. We also got a glimpse of Code Section 119 dealing with exclusion for meals and lodging. We did start off Chapter 4 with the predicate that all fringe benefits are subject to tax, right? Why? Regulation 61-21 says that all accretions to wealth are taxable. And once you assume that bias, then you can look like the hero if that isn't the case, right? Then we moved on. We skipped Chapter 5. We went to Chapter 6. And we saw that there's a big code section in the form of Code Section 1001 to compute gains and losses. We need the amount realized less adjusted basis. We know for gains, they must be realized and recognized. For losses, they must be realized, recognized, and allowed. Right? Realized, recognized, and allowed. In the first part of the chapter, in large part, Chapter 6, dealt with tax basis determination. We saw a whole series of code sections to help us determine the tax basis. 1012, 1014, 1015, 1016, 1019, a whole bunch of different code sections. And then the second part of the chapter dealt with what is the amount realized. We said, for amount realized, you really have to consider what is or what are the liabilities any property is subject to, right? Because amount realized is not only the cash received, fair market value of property received, it also includes any liabilities. Right? Then we took a hiatus. We moved on to Chapter 21. Talked about capital gains and losses, because once we figured out numerically how much, we have to figure out character, because character plays a big role in our tax system. There's implications about limitations for capital losses under Code Section 1211 and tax rate differences, right, under Code Section 1. So these are critical. We had to look at some of the mechanics associated with what are capital gains and losses. What is a capital asset? Finding Code Section 1221. We saw the big three. Inventory is not a capital asset. Accounts receivable, not a capital asset. 1231 assets, not a capital asset, right? Then we talked about the holding period under Code Section 1223. Courts have added their own judicial gloss to the meaning of the statute. And sometimes Congress has instituted various code sections, and in crafting various code sections, in some cases being magnanimous and being kind to taxpayers, For example, if you remember the Galvin-Hudson case, Mr. Hudson experienced ordinary income because there was no exchange. So in Code Section 1241, Congress decided to statutorily reverse that. Actually, 1271, not 1241. 1271 statutorily reverse that. The authors give us several code sections of that ilk. Then beginning in Chapter 22, we saw a characterization of the sale of depreciable property, and we talked in depth about Code Section 1231. 1231, that actually, 1231 ended, right, Chapter 21. And we saw the importance of 1231. Does gains exceed losses? Do losses exceed gains, right? That's critical because depending if the gains exceed the losses, it's all capital. If the losses exceed the gains, it's all ordinary, right?
Yep.
Okay. And then there's two exceptions. Servan, before you take a bite. You know one of the two exceptions? Duca? David? All right. You think of that, Jun Ho? Han? Jordan? All right, Joe. Say again?
Involuntary conversion?
Well, it's not sub-hodgepodge. But involuntary conversions aren't necessarily part of the sub-hodgepodge, right?
What was
Comes
the
from
question?
fire. What is an exception to Code Section 1231, right, Bimo?
Okay.
We have the main hodgepodge, but then we have the exception under 1231A4C. That's fire, shipwreck, theft. But it doesn't talk, if I may be mistaken, Joe, take a look. I don't think it mentions involuntary conversion. Okay? And then, Shervan, the second exception deals with what? Wendy?
The 5-year look back.
The 5-year look back, which is what? 5 years if you had 1231 losses, right? And in the current year, to the extent they weren't absorbed in prior years, those losses recharacterize your 1231 gains instead of being capital gains as possibly ordinary income, right? Well, I've tried, right? Comes with a few years of experience. All right, so 1231C, again, for the record, guys, does not change the numerical outcome. Okay, does not change the numerical outcome. Just be aware of that. All right, so we saw that the 1231, and then Chapter 22 introduces us to 3 new code sections, not new to you guys anymore. At least I hope not new to you anymore. First, Young, what? Right, 1239. Can you just summarize? James.
1245.
1245. We'll get these out on the table and 1250, right? Now, Young, what does 1239 say? Summarize it in a way that you could explain it to a client. Jack?
It prevents the characterization of certain assets as 1231 assets when it's a transaction between controlling interests.
Related party.
Related parties, yeah.
So what happens, Jack? Explain.
It, prevents, like, someone who owns a company from transferring, like, selling the assets to their own company.
Well, you can. We remember. Okay.
Characterizing it as a
Oscar,
capital asset.
you're.
I was just gonna add that you can't switch it, you can't capitalize it.
That's what I was, yeah, I was trying to say.
All right. I mean, let's, Jack, again, you can tell a client, if you engage in this particular transaction, it's not prohibited, but rather than commanding a capital gain treatment, because it's a related party, you're sort of selling to your alter ego, it's going to result in ordinary income treatment, right? If you guys could, over the next several weeks, and when you take corporate tax, in your own minds, try to boil down these things to ways that you can have conversations with people who aren't familiar with tax, because ultimately that's what you're going to be doing with your clients, right? And if you can explain it to your client in boiled down terms, you will have a much easier time yourself in mastering the material. And on the CPA exam too, you will see that if you can get these rules down into things that aren't just memorization, but you understand what's going on. In years past, I take some pride that people who take the CPA exam, maybe it's a selective bias that I only hear back from those who think they did well on the tax section, but generally people do fairly well if you pay attention here and put in the time, effort, and energy. You will have to review through one of the review courses, but you'll have a good foundation, and you'll hopefully do very well on the CPA exam, okay? Among other things. All right. Yes, James.
Very important. So the CPA exam for tax, do they focus on code sections, ordinary versus capital gain income? Is it kind of like
They don't focus
on?
the exam itself doesn't focus on code sections per se, but concepts. But by having the code sections, it sort of should frame you where those concepts are coming from. So again, this isn't designed to be a CPA review course, but if you excel here, you can take that knowledge base and readily apply it so that when you are studying for the CPA exam, it's much easier to absorb. But my point, Jack, is just try to get that into a format that you can have a conversation. And I say that to Wendy as well, to all of you. Communication is key. Okay? Having the right answer is great, but then you got to be able to explain. So, James, with that in mind, you raised 1245.
Yep.
Tell us about it. Tell me as the client, how would you describe what does 1245 come into play?
So when you dispose of a property that you've depreciated over time, the gains when
Can I pause and just ask, what kind of property would you call that, James?
depreciable assets,
Maybe put a better name to it?
property.
You want female? David?
I was gonna say depreciable property.
Title of the code says.
Say again?
depreciable property.
1231, right, James?
Yeah, but I wouldn't tell a client 1231 property. They don't know what the heck I'm talking about.
You know what? You might sound, if you don't mind me saying, you're right, but it might sound good to your client. Oh, when you have depreciable property or 1231 property, and use those as if, because you're right. Keep it simple, but then show you're with the program. So I think that 1-2 combination is
That
killer.
1-2 punch knocks them out, right?
Yeah. Oh, James, we're not paying you enough.
Keep that in mind.
All right, so I interjected, James, so keep going.
So when you sell the asset, up until the depreciated amount is ordinary income, and that's subject to ordinary income tax. And then anything that exceeds that depreciable amount can be treated as a 1231 capital gain.
1231 gain, because we don't know what the character is until we're patient, right? So we know if the gains exceed the losses or the losses exceed the gains for that year, right? So just be careful in your verbiage. I wouldn't refer to the client as a 1231 gain, capital gain, right, guys?
Yes.
Yes. And who was the one who mentioned 1250, Oscar?
Yeah, also 1250 is basically the unrecaptured section, and it basically says that it's kind of similar to 1245, which 1231 real
What kind of property? It applies to real property, right?
property.
Essentially buildings for our purpose.
And basically that application is actually the difference I think from 1250 to 1245 is real property versus
Well, it's not more, it is.
yeah, it is.
All right. So 1250, a few distinguishing factors. Respect to 1245, James was going to point out, it does not go in the weighing, right? Everyone agree? 1245 gain does not go into the 1231 weighing if gains exceed the losses, right? By way of contrast, when it comes to buildings, and you have a unrecaptured 1250 gain, okay? It is part of the 1231 calculus. So that's one distinguishing factor. And it is subject to a special preferential rate of 25% under Code Section 1H, whereas 1245 gain is treated as ordinary. Right? All right. So that is the three exceptions. 1239 does not come up regularly, as I forewarned you. That's its danger. Does not come up regularly, so therefore you have to be more attentive to it. And then Code Sections 1245 and 1250 come up with frequency all the time. So, yes, you are constantly bombarded with those issues. Do bear in mind that the final exam will be cumulative, so it will be proportionally much more heavily weighted towards what we do the second half, but that doesn't mean toss out all the code sections we looked at the first half. And just be careful because you guys know how quickly time goes, right? So you blink a few more times and we're going to be like, oh, final exam is next week. So keep pace, guys, because you don't want to fall behind. That's not good for you or for me. I'll remind you this, when you have corporate tax, I'm here to help. I recruited the gentleman who's taught the course now. He's one of the foremost corporate tax experts in the state. Alan Quarantine, he works in Recorder English. So if and when you have questions on corporate tax, not to let me know. You can let him know, but if I can help behind the scenes, I'm happy to help. Also, check your watch. October 26th, right? Coming up, right, Zemo?
Yes.
You check. So if you can.
Oh, you're doing that, right?
James, you're coming, right?
Yeah. The BMO comes.
All
Me
right.
and James are gonna go together.
You're gonna go to date, significant other?
Yep.
All right.
No. Not a thing.
Vegetarian buffet.
However you come. If you can come, that'd be great. Lots of excitement. Shervon, you're coming? All right. So, Jack, is that a yes too, or?
Told me last week, yes.
That's not true.
All right. Look, we got to get a good showing for professional accounting, guys. All right. So I'll leave it up to you. And I think some people have children, but they're rather young. I don't. Anyone in the room have children? No. No one. Oh, is that Wendy?
Yeah, but mine aren't very young.
Not very young. Well, then they should come. You can give them a taste of what your life is like. Have they been to the building, Wendy?
I have one who's almost a CPA.
All right, they should come. They get a lot out of it. All right. So again, guys, if you have any questions or issues, don't wait long. Just reach out to me sooner rather than later. All right. So as I told you last week, and as the exam emailed you, let's start with Chapter 12. Chapter 12, guys, let me just say this. One of the few chapters, maybe the only chapter, theoretically, you wouldn't need your Internal Revenue Code. Chapter 12, if you notice, is built almost entirely on case law, right? So it's an exception insofar as that's concerned. And why is Chapter 12 important? What issue does it help us ascertain? Go ahead, Oscar. Time of income, but what is the issue that these cases are supposed to go for? Oscar?
What I picked up from reading the case, an income to someone else.
There's a three-letter word that I'm looking for. Three-letter word.
Tax.
Tax is always a good word. But in this case, what three-letter word does this seem to address? We could play hangman.
E. Oh, you like it? Wait, did anybody
Oh,
say
W.
Q?
Ooh. Oh my God.
I was just about to get that too.
Who gets taxed, right? This is not the Abbott and Costello's. Who is not a person, okay? Who gets taxed, right? Which is a critical issue. Okay. Now, this issue is somewhat less important than it was in yesteryear, somewhat less important. And the authors offer some reasons why this issue, Chapter 12, has a little less relevance than it did in yesteryear. Anyone want to tell us why? Reasons. They give several reasons why this is perhaps less of an issue.
On the simplification of the current tax code.
What am I doing?
On the simplification of the current tax code.
Simplification wouldn't make this chapter less relevant. Well, Jordan,
A lot of the cases are,
they're all cases, but that doesn't make the chapter less relevant. These are the kind of cases you can still quote at the water cooler. Well, what were tax rates back in the 1940s and 50s? What were the marginal tax rates? How high did they go?
70%.
They went as high as 90%. Okay? So, that being the case, if you could assign to someone who is at a much lower tax bracket, say at 10%, you had $100 of income, and if you were at the 90% tax rate, you could assign to someone at the 10% tax rate, do the arithmetic, that would save you $80 on that $100. Everyone agree? So, when tax rates are much higher, marginal tax rates, that gives more incentive, right, for people to try to assign income to low-income taxpayers, right? Everyone agree? But in an environment where the rates are somewhat compressed, and they are today, the highest rate is 37%. So instead of being able to save, say, up to 90 cents on every dollar, you can only save 37 cents on every dollar if you could assign your income, say, to someone at a 0% tax rate. Right? So that's one reason. Second reason is that how is the unearned income of children taxed? The unearned income of children. Our book isn't up to date because the 2017 Act changed it. Go ahead, David, you were going to say?
it says in the book that it's taxed at the trust and estate tax rate.
It does? It's updated for that? It is. It used to be. You know what? I didn't realize that this version took that into account. All right? So it is. It's taxed at the trust and estate tax rate. Okay?
The children are taxed at the same tax rate.
They're taxed. If you guys open your code section 1. And you look at code section 1E. 1E is the tax rates for trust and estate. You'll see it's fairly compressed. Everyone see it? Doesn't take much to get to the top rate for trusted or estate. In code section 1G, essentially children on their unearned income, if you're a childhood actor or actress, for example, that's earned income, you're subject to your own tax rate. But on your unearned income, you're subject to essentially a flat tax rate. Okay? Anything above $1,000, essentially, children now, I'm oversimplifying, are subject to a tax rate of about 37%. So in yesteryear, people tended to try to put, look, many kids can't earn money, right? They're too young to really earn money. So the parents would give them stock and CDs, and they would earn interest, right, and dividends, unearned income, right? And that income would be subject to the child's lower tax rate. But now children, beyond a minimal threshold, their income is taxed essentially at the highest tax rate. So again, games people will play, there's less games to be played because children now, their income are taxed at a significantly higher rate. And also, trust and estates. Used to be, people would form trusts, and trusts themselves had their own bracket structure, and essentially into individuals, and people would form trusts, and that income would be subject to fairly low tax rates. Well, guess what? Congress in 1986 compressed those rates, just what you see here in Code Section 1E. So the income earned by trusts and estates, once again, essentially subject to the highest tax rate. So my point is, because of rate compression, the so-called kiddie tax, and the fact that you can't hide your income in trusts and estates, game is no longer as exciting as it once was. That doesn't mean that people will not try to assign income to people in lower tax brackets, but it's not as attractive as it once was. Without getting into the politics of it, depending on who's our next president, if there is a new president, you can see if tax rates go up, this chapter will have potentially more relevance, right? Lucas v. Earl is a really, really well-known case, okay? This is one of those that you're going to see a few cases, just like Crane, name brand cases that anyone in the tax world knows. There's about 10 cases that really stand out. Lucas v. Earl is among those. So notwithstanding, Jordan, the date of the case, it's still highly relevant. Justice Holmes wrote it. Anyone have a chance to take a look? So Jordan, you had your hand up.
So the husband's making a certain salary, he's getting taxed on the whole salary, so he thought.
All right, so picture, if you will, husband, can we make him earn $100,000? And what is his objective here?
To give his wife half his salary to save.
So Jordan said that he would prefer being taxed on $50,000 and his wife being taxed on $50,000, right? In the year 2019, Jordan, would that save any money? How? If you can.
Assuming the wife, how long do you take if you split your?
What would it?
It'd be.
It?
I don't know.
Female?
If you filed jointly, right, wouldn't it just be taxed
Yeah.
the same way?
In other words, if you file jointly or married filing separately, the tax is essentially the same. The rates. So this would not save money by assigning income to your spouse in the year 2019. So you might say, okay, this wouldn't save, because everyone would do that, right, Jordan?
Yeah,
To the extent you could. But what's relevant, and for your notes, and again, I'm not going to ask this as I think it's interesting as a factoid. When did joint tax returns come into being? It's been an evolution. I mean, women's suffrage, I'm going to show off my ignorance. What year were women allowed to vote? Something embarrassing, like 1920. David, I don't recall. Does anyone want to Google? I'm asking, I should know my point is, it was a different world when the code came into being, right? And this extended to taxes. 1920. 1920? David, look at that.
I don't know how I did that, but.
He's an activist for women's rights.
I had to prep him. It's a new movie. I saw a trailer too. I did see an interesting movie last night. I'm not saying you have to see this one. Brainchild. High school girls coming of age who got into top-notch schools, but then figured out that book smart. Thank you. What did I just say? Brain. Book smart. Galena, did you see it? Anyone see it?
I want to see it.
Sounds like a good movie.
It was an interesting movie. Let's put it that way. It's not going to get an Academy Award, but there's some funny moments in it. Interesting coming of age movie. So why would my brain mention that? I'm not sure, but lost that train of thought there. All right, but the point I'm making is that joint tax returns. There was an evolution in how the code unfolded, where in 1942, the first time joint married filing jointly was permitted. So keep in mind, Lucas Fierro, Jordan, there was no such thing as a joint tax return. So I think that's important, historical context, because now you can better understand why you might think the taxpayer here was inclined to do this. But one thing, and Jordan, did you guys ever read the Texas story? Kids, guys. There was a
Nancy Drew.
Nancy Drew, the Hardy
Not
Boys.
Nancy Drew. Who's the other one?
Hardy Boys?
Hardy Boys.
Magic School Bus?
Encyclopedia Brown.
Oh,
Yeah.
I've heard of it.
Encyclopedia
Yeah.
Brown. Okay. Jordan, this is an Encyclopedia Brown moment. Could our taxpayer here ever have engaged in this contract simply to save taxes? No. And it reminds me of a story in Encyclopedia Brown. In Encyclopedia Brown, there's a story where someone is selling he's selling it for $1,000 in Encyclopedia Brown, some sort of a weapon, and it's signed on it, and it's supposedly authentic, that says World War I on it, a sword. And Encyclopedia Brown is called to see if it's authentic. And do you know, James, why it was or was not authentic?
I think it was like the rust on the sword or signature.
James, you got to reread the story because Wendy obviously has read the story.
No, I never read the story, but how would you
Just
know it's
laughing
World
at
War
me.
I?
You wouldn't know it's World War I because in World War I, you didn't know there was a World War II. It was called the Great War, right?
Oh, that's pretty good.
All right. Now, by the same token, see? Can you figure out, Jordan, why you can't be right here? You can't be.
Oh, because I know that joint tax returns.
No, but there's something else about the fact pattern here. When did he enter into this contract? No.
1901.
1901. And what do you know, Jordan?
Revenue Act came in 1918.
Well, the real Revenue Act, when did the income tax come into being? Guys, don't you remember from our first class? When did the income tax come into being?
1930.
1913, right?
1913.
13. Vis-a-vis the 16th Amendment. When he made the contract, he wasn't doing this for tax reasons, obviously. He was doing it for whatever reason, to keep his wife happy, or who knows? We don't know. But he wasn't, one thing's for sure, unless he was clairvoyant, he could not have been thinking, gee, let me assign this because if they ever enact an income tax, I'll be able to save taxes. Right, everyone agree? So the question is, could he assign his income to his spouse, even though this was obviously not tax motivated, right? This assignment was not tax motivated. Agreed? So this is spelled out on page 240. The first full paragraph, about 3/4 of the way down to the right, it says, there is no doubt that the statute could tax salaries to those who earn them, provided that the income tax could not be escaped by anticipatory arrangements in contracts, however skillfully devised, to prevent the salary when paid from vesting even for a second in the man who earned it. And if you keep reading down, the next sentence, that seems to be the import of the statute before us, and we think that no distinction can be taken according to the motives leading to the arrangement by which the fruits are attributed to a different tree from that on which they grew. So essentially, I apologize in advance for all you draws out there, but if you have a tree and you have apples on it, it's your tree, guess who gets taxed on those apples?
Whoever owned it when the apples were picked.
I don't know if you grew the apples, James, you're going to be taxed on them, okay? They're your apples. You cannot take those apples and give them to female and say, female, get taxed on these, I'll be taxed on the ones I kept, okay? They grew on your tree, James, you will be taxed on them. Charles' income, he's got to be taxed on it. Believe it or not, I read a short called, I have it upstairs, 10 short stories about famous tax cases, and Lucas V. Earl made that list. And apparently, Mr. Earl was in the fruit shipping business, so I'm not surprised our judge here, even though it doesn't really have relevance to, you wouldn't know it from reading the case, because it doesn't talk about what he did. That was his stick in life. So maybe that's why the judge. But this metaphor, the fruit and the tree metaphor, you're going to see it everywhere now. Okay? So if you're wondering, gee, where did that fruit and the tree metaphor come? Lucas V. Earl, guys. Okay? Lucas V. Earl. Commissioner V. Giannini. Some of you guys were wiped out from reading so much tax beforehand, so I don't know how you viciously, but I see Oscar's hands up. What goes on here, Oscar?
The taxpayer is the president of the corporation. The corporation is doing well.
All right, so president of the corporation is doing well. He's making a lot of money, right?
So he has 2 bonuses in a year.
Yep.
The first one he accepts. Yeah, the second one he does not. He rejects
Okay,
it.
so he's going to get 2 bonuses. Accepts the first bonus, then declines the second.
So the corporation to do as they please with that amount.
Okay?
The reason says that.
And where does the money go?
They go to the University of California.
I believe it does go to the University of California. And anyone have a computer out?
Yeah, University of California.
If you got a computer out and you're not surfing because you're just having fun, not paying attention to tax, but, well. So anyone have a laptop? You want to just look up? Yeah, just Google Giannini, University of California. And so what you'll see, I think you'll see, you should see.
I see a guy who's an associate consultant who went to University of California. But beyond
Let's
that,
see a building. Giannini, University of California. Good, because there's a nice building dedicated
I
to
see it.
him.
Oh, yeah, that's nice.
So, I forget what his first name is, which might make it easier. Yeah, A.P. Giannini. Sure, do you see a building, Wendy? Giannini Hall. Joe, did you see anything else?
Just the buildings and a picture of him.
Okay.
Yeah.
All right. So, Oscar, he says, don't need the money, get it to University of California. Coincidentally, he's probably going to get a nice honor there, maybe football tickets, right? Things like that. And a lot of accolades from, I presume he graduated there. I'm not sure of that. And what is the IRS position?
Do you want to tax that amount, saying that it's
Now, by the way, just so people realize this, you might say, rightfully so, Oscar, if the money's going to the university, and let's just keep a simple number, $1 million, is that, what was the IRS fighting? Because they take it into income, meaning he, the taxpayer takes it into income. You guys probably know that you're allowed charitable deductions, right? So, was the IRS fighting a losing battle? Because even if he took it into income, $1 million, he would get an offsetting deduction. So it seems like it's, say again, Wendy?
Is it the same rate?
Well, it's a deduction, dollar for dollar. But, just so you know, under Code Section 170, Code Section 170 is what permits deductions. You're only allowed to take up to 50% of your AGI, okay? And you can carry it forward up to, I believe it's 5 years. But the point is, and I don't know what the law was, Oscar, at the time, but he may not have been entitled to full use of the deduction. So on one hand, he had to, the IRS was saying include it. On the other hand, he may not have been able to fully utilize the deduction. So I just want to leave that. We haven't spoken about deductions, we will, but I just wanted to point that out to you. Amy, we have this building, we have the taxpayer, the IRS is jumping up and down and saying, no, you've got to include it in income. And who prevails here, Oscar, and why?
taxpayer.
Why does the taxpayer prevail?
Well, money not beneficially received by the taxpayer did not count as income, especially he had no say in the disposition of it.
Well, a few things go on. The court said, this is the biggie that I think you have to have a real leap of faith. It says something to, I'm going to paraphrase, but the court says, so far as the taxpayer was concerned, the corporation could have kept the money. Now, let me just ask. When Mr. Giannini said, no, I won't take that bonus, I think it would be illusory to think that the company could say, oh, thank you, we'll now use it to pay more salaries to other people. I think when you're president of the company, don't you think behind the scenes saying, gee, I'm not going to take the money, but make sure it gets to where I want it to go? So I think the court, maybe they didn't have entered into the fact that what he was really doing. So on page 245, the second full paragraph right in the middle, it says, so far as the taxpayer was concerned, the corporation could have kept the money. I just have next to that, really, with a big question mark, right? If you want a summary of this, of the various cases here, guys, look on page 244, beginning in the second full paragraph. There's a nice overview of the Hort case, the Horse case, Eubank, a whole bunch of different cases that are, the authors do a nice job just summarizing the law. Now, there's a revenue ruling, 66-167, dealing with executors and administrators. Generally, under state law, if someone dies and you serve as an executor of that person's estate, or as an administrator, you're entitled to commission. Jersey, the commissions are, just so you know, it's not 5% on the first $200,000 of the decedent's estate, 3% on the next $800,000, and on anything above $1 million. That's statutorily provided commissions, and that could be pretty significant money, right? In most cases, if you're serving for a parent or a sibling, most people waive their commissions, right? They say they're not going to take the commission. If they say they're not going to be if they're not gonna take the commissions, are they taxed on the commissions, guys? No. Everyone agree? That, and this revenue ruling says essentially that if you formally waive your commissions, there's an implicit waiver, you will not be taxed on that statutory amount of commissions. Now, if you say you're taking the commissions and 2 years later you decide not to take the commissions, well, you'll still be taxed, and then will have been deemed, if you don't take the commissions, you have made a gift to the beneficiaries, right? Because if your commissions are $100,000, and 2 years after the estate is open, you decide not to take the commissions, then there's something else going on. Right? So just call that to your attention. It makes sense, right? Unlike the Giannini case, which most of us would agree there's some direction of where that money's going. You don't take your executive or administrative commissions, you're not directing where those funds are going. How about Revenue Ruling 74-581? Many times.
Does that have to do with all commissions or only for the?
I think you can extrapolate, James, from this and apply it in many instances to other forms of commission.
For the Giannini case, where they was just saying that he directed.
I think if you direct the money, if they had evidence that he directed where it went, I think the court would have no choice. There was not enough evidence, or there was no evidence, to suggest that he truly directed it to University of California. Now, some of you are working for big firms or regional firms, and several of my students now over the years, they lecture on behalf of these firms, and sometimes they get paid honorariums. And what you'll learn at most of these firms, what do you have to do if you get paid an honorarium?
Donate it back to the university?
Wishful thinking on the part of Rutgers, but no. What do you think if you work for KPMG and you give a lecture and you get a $500 honorarium?
Or as gross income.
Email, think more cynically.
Give it to the firm.
Yes, KPMG says you're working for us. This is in the scope of your ambit of your work responsibilities. Assign the check to us. Careful, guys. I've seen sometimes people do some things where they don't tell their firm, and you can get into hot water. I've seen people who have practices on the side, so they work at the firm, but they also maintain a client base separate and apart. That can get real dicey quickly. So just really is not allowed. But I've seen people do it. Say again, James?
Nothing.
All right. But in the case you get an honorarium, guys, and you turn it over, should you be taxed on it? Say no.
No.
Oh, if it's not under your name.
And why not?
Not your income.
Well, you get paid it, you earned it.
But you're not
You're
you're not
not
in control of it.
Well, you can say under Revenue Ruling 74-581, if you're contractually obligated to turn it over, then it's not yours, right? Now you have authority. I don't know about you guys. I try every day, speaking of apples, eat at least one apple every morning. David? No?
Oh, I agree.
You have an apple every day?
I try to, yeah.
I do too. I'm not a big fan of green apples.
Oh, they're my favorite. Granny Smith, what are you doing?
I'm a big pink lady.
Gala is one of mine, too. The Gala apples.
Yeah, I like the Gala one.
Yeah, me too.
Those are good.
So I encourage people. I think it's a good habit. So as long as we're talking apples,
But
go have an
doctors out
apple.
of business, you know?
Right? Page 250. Executive has a salary position with high rolling corporation under which he earns $80,000 each calendar year. Who is taxed if executive at the beginning of the year directs that $20,000 of her salary be paid to her aged parent? So in this case, Young, who gets taxed, and Max, see if you agree. Lucas Fiero. Tax the executive can't assign away the fruit from a tree upon which it grew, right? Okay, this is, Lucas Fierro. Whose tax if executive at the beginning of the year directed that $20,000 for a salary be paid to any charity the board of director of high roller selects. Executive is not a member of the board. Okay? Executive, Roger, do you agree or disagree? Say it loudly. Say the executive. Young?
I don't agree.
Why not?
I'm not sure it's the right revenue ruling, but -581.
But that deals with assigning it back to your employer. Here you're giving to charity. Jordan,
Oh,
yes.
I mean, commission reimbursement.
Okay.
Okay, I would use G.
Okay. Under G&E, you said the executive. Let's just look at question C at the same time, and then we'll try to. Same as B, except the executive makes the same request with respect to a $10,000 year-end bonus which corporation is announced towards the end of the year based on services rendered during the year. Okay? So what difference, if any, B, the taxpayer is directing at the beginning of the year. In C, the money has already been earned. Right? In C, the money has already largely been earned. Now, here's my response. B, under question B, Giannini opens the door, I think, to saying that the executive would not be taxed. Because the executive is essentially saying, instead of paying me $80,000, only pay me $60,000. And I haven't performed the services yet. So that being the case, this other $20,000 is you guys essentially you can do it as you please, but it's not binding. Where if you look by contrast in problem C, a year-end bonus where the money's been earned is already problematic because you probably have some sort of right to that money under labor law. And now you're saying directing it to charity, which, Jordan, to get to your point, once you direct it, it's more problematic. Giannini is the best of all worlds where theoretically he didn't direct where it goes. I'm not saying question B, you will win.
So what's your opinion on B? What's a correct answer for B? You said both.
I know you want the black. James,
Yeah,
I don't know, and I'm not trying to be equivocal, so your notes, I'm not trying to make them fuzzy, but I don't think there's a crisp right answer with a capital R. I think this is a little bit less favorable than Giannini, but it's arguably, this is being done before the services are rendered. Question C is far more problematic and likely would result in all the money being taxable to the executive. The fun thing about tax, guys, it's not always binary yes or no. Sometimes you get into this, it's not entirely clear. Jiang?
But in the question, they said beginning of the years, right? So
Right.
it can't be earned.
Not earned at the beginning of the year. He's saying, just pay me $60,000 for the year. The other 20, like it to go to charity, but I haven't earned it yet. So just saying, pay me less, and with that extra money, where in question C, he's already earned it, that bonus.
Saying like he's not giving a specific charity, although he's directing it, not anything specific. He's saying.
Yeah, basically. And again, I'm not saying this is winning, but it's an argument. Where question D, James, you'll be glad to know, I think we can give a definitive answer here. Who is taxed as executive in her corporate role gives a series of lectures on corporate finance in a local business school pursuant to contract with High Roller, turns over $1,000 honorarium. Who's taxed on that? Go.
The corporation,
Right. Why?
revenue ruling 66-167.
Was it the revenue ruling 67-167? Or is it revenue ruling 74-581?
74-581.
All right, just be careful what you cite to, right? So just notice, guys, the first part of the chapter, and some people, headings are important. Headings are important. The first part of the chapter deals with assignment of income from services, right? Everyone see that? That's the first half of this chapter. The second half of this chapter deals with income, assignments dealing of property, right? Notice the new subheading. Come from property. And Mr. Helbring, who's graced many of the case, right? Former commissioner, as you know. Case. Anyone have a chance to read this? And just by way of background, some of you or your parents may have had bonds, okay? And they were, say, $1,000 bonds that paid interest, okay, that had a 10% interest yield. Every year they paid $100. There are these coupons at the bottom of the bond, $100 coupon. Get the gist. There are these coupon bonds, and in the old days, everything's now electronic. In the old days, you used to be able to detach these $100 interest coupons annually and give them to your local bank, and they would give you $100. And the issue in Helbring v. Horst is who should be taxed on these $100 interest coupons. I'm oversimplifying the numbers, but that put that as your side.
For bondholders?
Now, the bond. What is the IRS position? What is the taxpayer's position?
He gave this to his son, and
Okay, so taxpayer gives some of the interest coupons to his son.
Yeah.
And what position is the taxpayer? What position does the taxpayer take? Who should be taxed?
well, according to the ruling,
Who should be taxed?
not the
So,
son.
I mean,
So,
I'm saying, what position does the taxpayer embrace? Who should be taxed?
His son, he claims his son should be taxed.
Wait.
Son, he should not be taxed, right, Oscar? And the IRS is saying who should be taxed? Taxpayer, the holder of the bond, okay? And we have a little bit of a history of the case. We're introduced to that at the tax court level, the IRS wins. At the appeals court level, the taxpayer wins. So this is a U.S. Supreme Court case from the 1940s. Now, Oscar, who wins this case ultimately? Who does?
taxpayers.
Wins or loses? Loses, right? Everyone agree? Taxpayer loses here. The IRS prevails. If the IRS didn't prevail, let's just take a step back. If the IRS didn't prevail, the integrity of the progressive rate structure was at risk. I'll repeat. The integrity of the progressive rate structure was at risk. Why? Because if anyone can just simply give interest coupons to people at lower tax rates, right, they can essentially thwart the progressive rate structure of the income tax. Fine, there's no kiddie tax back then, right? So if you could unilaterally say to your child, here's a $100 interest coupon, you're taxed on it. And what could the child do once the child gets taxed on it a week, a month later, give the $100 back to dad, right? Or mom, as the case may be. So just by manipulating who's taxed at the snap of a finger, that's wholly problematic. And I think the court realized that as early as 1940.
So it went, just to clarify, it went tax court, IRS wins, bondholders responsible. Then it got appealed. They said that the taxpayer one should be the son responsible. And then a third time it went to the Supreme Court?
Yep.
Okay.
And there's some good quotes here that resonate. On page 252, the first full paragraph, 4 or 5 lines down, it says the taxpayer has equally enjoyed the fruits of his labor or investment, and has obtained the satisfaction of his desires, whether he collects and uses the income to procure those satisfactions, or whether he disposes of his right to collect it as a means of procuring them. So, in other words, by giving away these interest coupons, Dad presumably had $100 worth of, I'll call it, utility, marginal utility, put in economics terms, because essentially the power to dispose of income, power alone to dispose of income, is tantamount to enjoying the income. And the court makes that clear a few paragraphs later at the bottom of page 252. So I was essentially paraphrasing it. The paragraph that goes from page 252 to page 253, the first line, the power to dispose of income is the equivalent of ownership of it, right? That quote? So if you have the power to dispose of income, and you do, you exercise that power, well, that's the equivalent of having that income inure to your benefit. If you go second paragraph, page 253, the dominant purpose of the revenue laws is the taxation of income to those who earn or otherwise create the right to receive it and enjoy the benefit of it when paid. Just so you know, we're still in the fruit of the tree. Final attention to page 254. First full paragraph on that page, 254. 3 or 4 lines down, it starts, when by gifts of the coupons he has separated his right to interest payments from his investment and procured the payment of the interest to the donee, he has enjoyed the economic benefits of the income in the same manner and to the same extent as though the transfer were of earnings. And in both cases, the import of the statute is that the fruit, notice the fruit, is not to be attributed to a different tree from that on which it grew. So essentially, by giving away a few apples, but retaining the tree, right? Stay with the metaphor. Giving away, the tree has, if you guys remember from your childhood, 10 apples on top. So you have 10 apples, you give away 3, but you keep the tree, you're going to be taxed on all 10 apples. Agreed? Larrabee Commissioner. What happens in this case? Suppose, in this case, wife dies, leaves $1 million in trust for the benefit of the husband, but the husband only has an income interest in the trust, okay? Everyone have that? I'm not sure. All we know is, truth be told, we only know that the husband has an income interest. It's not clear how we got it, but let's just assume that's the most typical scenario. His wife dies, left him $1 million in trust. He gets the income from that trust for life. What does he do with that income interest, Jordan?
He assigns a portion of the future.
He assigns the entirety of that interest to his children, right? And what's the issue? What the issue is, who, right? Anything in this chapter, who gets taxed, right? Should he be taxed or should his children be taxed? And the IRS argument is that he should be taxed. His argument is his children should be taxed. Jordan, who wins and why?
He wins, and they say that the kid.
Why?
The income's coming from the kid.
I don't know what you mean it's coming from the kid.
Well, because didn't he say they properly transferred and made those kids the assigned owners?
Keep in mind, in this particular instance, go ahead, Oscar.
Clarify real quick. The difference between the last case is that in this case, property was transferred entirely.
Yeah,
So that's the difference. That's why
big difference. He didn't retain the tree.
So he gave away his ownership.
Gave away the entirety of what he owned. Right? Because he gave away the entirety of what he owned, did not remain taxable. Last paragraph on page 256 of the case. We conclude that the assignments were valid. The assignees thereby became the owners of the specified beneficial interest in the income, and that as to these interests, they and not the petitioner were taxable for the tax years in question. Stranahan. What happens in Stranahan? And you might say, why are the authors just giving us a series of cases? Well, this series of cases is the framework for all of the assignment of income. It's not code sections, right, guys? So, and these cases are not old and cold. These cases, notwithstanding their ages, they are old, but they're still relevant today for sure. Stranahan. We had a question a few weeks ago about the Stranahan case dealing with the character of income, if you recall. It said recall the Stranahan case, but now we finally look at it. But here, what was the father doing? The father had stock, right? The stock paid dividends. We got that? The stock paid dividends. And over a certain number of years, it was going to pay about $122,000 of dividends. And the son is going to buy dad's right to future dividends. How much does he pay dad? He pays dad about $115,000. You might say, is that really arm's length? Because the son's going to be entitled to $122,000 worth of dividends. Well, the son is paying some discounted amount, right, to take into account the time value of money. So he's paying $115,000 to receive $122,000 over a few years, right? And why would the father? The code, guys, right? The Internal Revenue Code is very well designed to stop people from accelerating, we'll see this, accelerating their deductions, okay? The code, and we're going to get into deductions after our break, very good at impeding, curtailing, limiting taxpayers' ability to accelerate their deduction. What is the code not well devised for? When taxpayers seek to accelerate their income, normally Congress is the benefactor when people accelerate their income, right? But in this weird circumstance, this taxpayer sought, the father, to accelerate his income because he had expiring losses, okay? So it was to the father's advantage to try to accelerate the income. So he did. And the question is, who should be taxed on these monies? Given that arrangement, should the father be taxed on the dividends or should the son be taxed on the dividends? And the father, did he pay a price for engaging in this kind of game? And Oscar, you're shaking your head yes, but you probably don't know my sense of humor. What price did he pay? Notice the name of the case. Oh, someone upstairs didn't like the game he was playing, right? Because he is no longer with us. Right? So be careful about the games you play, right? Anyway, so he apparently died before this case was resolved. All right. So putting that issue aside, Oscar, who prevails here and why?
Well, if I remember correctly, he gave consideration.
Who's he? You got to be careful.
Stranahan.
There's two Stranahans, father Stranahan and son.
Yeah, the father.
Do you say he gave or he received consideration?
I'm saying,
But he was paid by his son, right? And the court, who prevails here? Do you remember? The father, right? The father prevails. That the court said this was a legitimate transaction, that he was at liberty to do that. And ultimately, the dividends remain taxable to the son.
Professor?
Yes, sir.
When you mentioned that, so you said before that if you give your entire interest, you sell that, then you're no longer responsible for the income, future income. What's the authority there? Is there a case?
That's Blair v. Commission. And in this case, taxpayer retained the stock. He just sold the future right to dividends. Nevertheless, court said that this had economic substance. I really have to say, I'm not so sure I agree with the court. This is kind of a strange case. And just so you know for your notes, another code section 77010. I'll repeat. Section 77010 that was instituted about 10 years ago. That obviously postdates this case, right? Postdates this case. And I just wonder in the year 2019 whether or not the taxpayer, Code Section 77010 says that to be respected, the transaction must have economic substance beyond pure tax. And B, this is entirely tax driven. There's no other reason the taxpayer would have entered into this transaction. So I wonder if the IRS in the year 2019 could have put the brakes on this transaction. This case, guys, Stranahan, is not a case that you can name drop at the water cooler. Okay? Lucas Fierro is, Elvering v. Horst, certainly. Stranahan, not so much. Right? And like I said, I think it's questionable whether or not it would prevail today. Susie Salvatore, the last big case for the moment. What is Susie Salvatore? What happened here? And in not very high level. Anyone remember? Lena, you get this far? Wiped out from the Wendy, do you get this far?
No.
Anyone? Oscar, you're on a roll.
Contracted to sell the property, but at the same time, she transferred.
All right, picture if you will. Okay, let's pause for a moment. Woman owns gas station, right, Oscar? I believe she inherited. Okay, so you're thinking code section 1014, 102. But now she's gifting it. And when you gift it, what code section applies with respect to your tax basis? Tax basis.
Oh, the tax basis.
Say again, Shervon? 1015, right? Which is what rule, Shervon? What rule applies with respect to gifts and basis? Say again, Delina?
The person that
It's the asset as a carryover tax basis, right? Everyone agree? So he's going to give this property to her children. It's under contract, right, Oscar? The gas station is being sold, but before it's actually the deal closes, she gifts over, I believe, half her interest to her children, and they sell the property. Mom sells the property with the children. They recognize the gain. What's the IRS complaining about, Oscar?
Like differently than Stranahan, they're saying that there's no.
So what? Well, we know that it's a gift, but that's okay. That's legal. What's the real issue, Oscar, for our purposes here?
He's avoiding the tax.
Right. Who should, get back to the word who, right? Who should be taxed on the gain? Should mom be taxed on the entirety of the gain? Or should one half be taxed to mom and one half be taxed to children, right? Now, normally, guys, with a gift, I bought a building for $100,000. It's worth $1 million. I give it to Shervon. Sell it sometime later. Who's going to be taxed on the $900,000 gain? Me or Shervon? Shervon, okay? So you may not remember, but Code Section 1015 explicitly permits the assignment of the fruit, right? Everyone agree? That, like nature, you're assigning income to the donee. Agreed? Who wins in this case, Oscar?
Pretty much the commissioner.
Darius wins. Why? Because what distinguishing in this case, what is the factor that distinguishes this case from others? Why is this case different from the case where I just gave Shervan appreciated property?
You didn't assign all of the income?
Well, it's one half, but even if I gave Shervan one half of the property, I think the outcome would be the same. I would be taxed on half, he would be taxed on half, and that would have been permissible. Jordan, you were going to say?
The way she handled it, she gave it right away to the kid right after she sold it, right after.
Well, there was a binding contract, right, Oscar? So once there was a binding contract, right, things had been set in motion that were irrevocable, right? So essentially, she was the party to have sold the entire of the property. And once you do that, right, too much water has gone under the bridge to say, oh, no, in this case, it should be taxable to my one half in this case, to my children, right? Didn't she enter a loan into the binding contract? So in this case, it was too late for her to pull back. She had given away the property to her children here earlier. It would not have been the case. But here, there was already a binding contract on the property. That thwarted the ability, right, to have the tax effects go to someone else. Right? So for your notes, she gets taxed on the entire amount, the entire gate. There's a revenue ruling, 69-102. 69-102. This revenue ruling, unlike the other ones in this chapter, is a very hard one to read. Okay? It's a hard one to read. So let me see if I can just, and we're going to see it in the problems, okay? We're going to see it in the problems. Let me just simplify this. Is if we have our apple tree, okay? We have our apple tree. There's a bunch of unripe apples, but there's a bunch of ripe apples, okay? The red is my version of ripe apples, right? And you give away the tree, and there were ripe apples on it. It's taxed on the subsequent disposition for the receipt of, and the apples are subsequently harvested and sold. But who should be, and there's 10 apples, but 3 were ripe at the time, 7 were not. You give away the tree. Who should be taxed on the 10 apples when they're ultimately harvested? The person you gave it to with the caveat, and this is what this revenue ruling stands for, 69-1, is it 109? 102. Is that if you have existing ripe apples, income, and you subsequently give away the ripe apples, you will remain taxable. So in my simple example, revenue ruling 69-102 says that whoever you gave the apple tree to with the apples, you will be taxed on the 3 red apples, whatever money those yield, and whoever you gave the apple tree with the unripe apples will be taxed on the remaining 7. So again, let me just metaphorically say, this revenue ruling stands for a simple proposition that if you have income which has matured, haven't taken possession of that income, but it's mature, you will be taxable on it. But anything that is not ripe will not be. You're saying, I'm really not sure what Soled is saying there. But just wait. After the break, when we go through a problem or two, you're going to see a good illustration of this rule at play. Okay? If it's not ripe, you're not taxed on it. Oscar.
You're saying that if you give away you're liable for that.
if you could have taken the ripe apple yourself and you didn't, still going to be taxed on it when it's harvested. And again, we're going to have an illustration of it. Now, the authors on page 266 and 267, pages 266, 267, go through and they offer two cases. On page 266, 3/4 of the way down, there's a case Campbell, Prothrow, in which there was no ripe income. So in that case, the taxpayer was not taxable on any income because the income, and this time income was in the form of young calves. Okay, income doesn't always have to be in the form of apples. Income in this case was a young calves, CALVES. In contrast, on the bottom of page 267, there's another case, Tatum, TATUM, in which the income was deemed ripe. So if you haven't looked at these, once we go through the problems over this weekend, if you look back, those two cases will help illustrate Revenue Ruling 69-102. When it comes to dividends, what is the important date to see who gets taxed on dividends? What date controls? Is it the declaration date, the record date, or the payment date, or the date of actual receipt?
Declaration.
Record date. Whoever is of record, okay, entitled to the dividend will be taxed.
Professor.
Yeah.
So what is the value of the cows and
What is the what?
what is the base for the tax here, like cows, like
Cows?
yeah.
Well, remember, if you look at this case, and we're not seeing the whole case, we're just seeing an excerpt, they were donated to charity.
Yeah.
The question is, should the taxpayer have first been taxed on the value of the calves and get a charitable deduction, or because he assigned them when they were young calves, the income was not ripe, and therefore he assigned them before they were income and should never enter onto his tax return. Oh, guys, let's do this. Let's take our 9-minute break, come back, and let's go through the problems, and I think the problems will offer some clarity here. So hold your questions. We'll come back, and then remember, we're going to finish this up and then get into issues of deduction. So let's talk on page 269. Let's get through these problems, and then I want to begin the next our next chapter, meaning 14. Yeah, father owns land which he purchased several years ago for $80,000. It has a current fair market value of $90,000. Father leases land on a 10-year lease and is paid $6,000 of rent each year, semi-annually, April 1st and October 1st. $3,000 each payment. For the prior 6 months, use the land. Okay, so you pay him after you use the land. You get paid $3,000, $3,000. What tax consequences for father and daughter in each of the following alternatives? And just, I know this seems obvious, but sometimes people miss this. So we have year 1, and we have April 1st. April 2nd of the current year, father assigns daughter all the future rent payments, okay? So let's just go around the room, and Wendy, Galena, you tell me who gets taxed here and see if you agree with either. And if there's a difference of opinion, we'll have a third person be a tiebreaker. So Jordan, you're on deck. Wendy, Galena, Jordan.
Father, because he owns the land?
You agree or disagree?
Yep, I agree.
All right, but you guys all agree with each other, but of course, you would want to give us authority, right? Because what good is an answer if you just say it is? I mean, even the Supreme Court cites authority. It just doesn't issue edicts and says, this is the way it should be done. It says why it should be done. Say again, Galena? That deals with income from services. We're now dealing with income from property. Halvering v. Horse, right? Halvering v. Horse, right? Because once you say that, then your client or your supervisor, right, has something to go on and says, oh, okay, it's not just because you said so, but there's a U.S. Supreme Court case that backs you up, right? So that's a much better feeling.
Was the father for all 6,000 of it?
Yep. Well, remember, yeah, he got paid the April 1st and then the October 1st going forward. Rumor has it, I haven't been outside since very early this morning. Is it as hot out there as they say?
Oh, it's beautiful. So nice.
I think by 9 o'clock tonight it's supposed to be down to 65 degrees.
It's gonna get real rain.
Yeah. Yeah, so enjoy it, right, James? Question B. On April 2nd, father gives daughter with the land with the right to all future rent payments. So in this case, Young and Max and Paducah. So Young,
Daughter?
daughter. Max, I'll ask you.
Daughter.
Paducah. All right, then we need authority. Why? Boss? You have a reason, Max? Young? Say again? Which case? Blair. It's the Blair case, where if you give away the entirety of what you own, the recipient will be taxed, right?
Oh, yeah, Blair.
All right, but you don't want to do it after your competitor has beat you to it.
Sorry, I really lost the job.
You already lost the job. And listen, I know we can all sort of laugh, and Young, it's great to be self-deprecating, but in the real world, it's intense, and people are going to steal your lunch. Right?
For all of it, for the 6,000?
Oh, well, the father owned it as of April 1st, so he would be taxed on that.
So it would be the 3,000.
Yeah.
From October.
Okay, on April 2nd, father gives daughter a 1/2 interest in the land and the right to all future rental payments. So, in this case, David, and then Robert, and then, Raza, who gets taxed? David. Say again?
I think both.
I don't know. Well, let me guess. Robert? Raza? And how much? Give me numbers if you're going to say both.
50.
What do you mean 50?
So there's 1,500 each period for the father and daughter. So
You say the father gets taxed on 4,500 for year one, daughter gets taxed on 1,500.
No.
Rod?
It would be 45 because you have to pay the 3,000.
It's the first payment, right, David?
So
Needs to be
that's
taxed.
1,500 for the second.
Oh, what's your authority? Go.
Salvatore, Commissioner.
Deals with a pending sale. That's not. There's no sale here, so I don't think that makes sense. And you can extrapolate, right? There may not be a case directly on point, but isn't it somewhat akin to Blair v. Commissioner, where you give away half your property? Usually, it's not the whole property, but you're giving away half the trade. And you shouldn't remain taxable as to that 1/2, right? Father owns an income interest in a trust which owns the land. And on April 2nd, father gives his income interest the right to the succeeding rental payments to his daughter. So, James, your hand's up. And then,
Yes, so the father would be responsible for the first period, 3,000, and then the daughter for the second period because of Blair v. Commissioner.
right, this is the Blair v. Commissioner case directly on point, right? So on December 31st of year one, father gives his daughter land with the right to all future rental payments. Remember, there's year one and year two. How much does father get taxed in year one? Hey, Robert? 6,000. Everyone agree? Year one, dad gets the 6,000. Agreed? And year two.
Year two, the daughter's gonna have the full tax liability, $6,000,
Right?
because of helping a horse.
Okay, you agree? Disagree? Back? What year?
He gave it away in the last day of year one.
What would be your authority?
I'm saying the authority's Hellbring versus horse.
Well, remember in Hellbring v. Horse, you retain the tree, and here the tree is not being retained. Right? He's giving away the.
Oh, no, for the first year.
For the first year, he held the property, so it's no issue. Year two is the question mark. Say it loudly, or Robert. Does anyone see some ripe fruit as it's December 31st on the tree? Any Granny Smith, David, you see on that tree? Right? 69-102, right? Remember, as it's December 31st, isn't there 1,500 of ripe fruit staring you in the face, guys? Because the tenant has resided there, and that money is owed to the father, right? He's a cash method taxpayer, so he's not going to accrue it in income, but the money is truly due and owed. Agreed? And that revenue ruling 69-102 says, hey, if there's ripe fruit and you give it away, and this is definitely ripe, just can't be harvested yet, right? This is a contractual obligation that it get paid on April 1st. The father is going to remain taxable on the 1,500 when it does get picked or harvested, which is April 1st, and the daughter will be taxed on the balance. So this is the clear, hopefully, this makes sense from your vantage point now, that revenue ruling 69-102.
Why 1,500?
Because as of December 31st, right?
Yeah.
1,500 is due, right?
Oh, okay. Yeah, it's not.
Right?
Yeah,
So it's 6 and 6.
You got it?
Yeah.
6,000 for the first year.
For the father and,
Yeah.
right? 7,500 for the daughter. 45, I mean 45. All right? Any questions? Everyone can handle that. Everyone see it. All right, on April 2nd, father sells to the daughter the right to 2 succeeding interest rental payments for $5,000, their fair market value at the time of sale. It's taxed on the future rent payments. Daughter gets taxed in this arrangement. Does this sound vaguely familiar, David? You're shaking your head.
I think it sounds like the Stranahan versus Commissioner.
It's the Stranahan case, right? And if you take Stranahan as being good law, okay, let's assume it is, what's going to happen here is that daughter is going to get $3,000 as of October 1st, right? And she's going to get another $3,000 April 1st of the next year. Agreed? How much did she pay for this, guys? $5,000. So essentially, keeping it simple, her basis in that intangible right is 2.5, right? So she's going to be taxed on $500 the first year. And taxed another $500 year 2. And the dad, what's his objective? Going to be taxed, right, on $5,000 of rental income the year he receives it. And he can't transform its character, right? Mr. Arrowsmith, he's got to be consistent. And isn't this just a substitute for rental payments? So he's taxed on $5,000, and the daughter would be taxed appropriately on $500 and $500 in 2 different tax years. This be achieved in 2019, not clear. But this is the Stranahan case in a nutshell. And notice, in Stranahan, he had an expiring loss. The only thing this would do is our taxpayer could accelerate the income, right? Our taxpayer is accelerating $5,000 of income. This is very unusual, right? Taxpayers generally don't like to accelerate income. Maybe in this case, he had some sort of expiring loss he had to use. Anyone have that? Question G. On April 2nd, father sells some land and directed $90,000 of the sales price be paid to daughter. Father sells some land and directed $90,000 of the sales price be paid to the daughter. So, Eugene and Jack, who gets taxed on this? Taxed on the 1001 gain. Say again, Galena? And 15 deals with a gift. It doesn't deal with this issue. Joe? You say Lucas Fiero, that deals with services. Sure, right? Is this the Susie Salvatore case? Even worse, he sold the property. But problem H, father negotiates the above sale, and on April 2nd, he transfers the land to daughter, who transfers the land to the buyer, who pays the daughter $90,000. Zach, Galena, Wendy, Jordan, does that change the outcome? This is the Susie Salvatore case, right? So both should be taxable to father, both instances.
Prior to.
Yeah, the income hasn't been recognized yet. Contrast to problem B, after the lottery winning, right? Because it's already matured in his hands. Revenue ruling 69-102, the fruit is ripe. I know this sounds silly, but when I used to participate in a lottery pool at my old job, we used to go around, get the ticket, and then we'd create assignments, notarized assignments, to assign to our children the lottery winnings beforehand. Okay, so only at a tax firm would you see that being done, but it was truly being done.
What advantage did you have there, though? Wouldn't you be taxed at the same rate?
You would be essentially, but for gift and estate tax purposes, you can minimize your ultimate estate and not incur any gift tax. So if the lotteries were multi-millions of dollars, that could save.
If you're thinking ahead, you're saying you would have eventually had to give, leave it for your sons.
Well, remember the estate tax exemption for 20 plus years was $600,000. You didn't have to be wealthy to have a taxable estate. So thinking ahead, and it's one of those things, James. When in Rome, you do as the Romans. So everyone else is like, well, how could I not do it, right? So I think I shared my story with you guys of why I don't play the lottery, right?
Yeah, you did.
I did. Just be careful not to play the lottery, because if you ever lose by one number, not going to be a good day. Question 2C. Lucky wins the lottery, but properly elects to be taxed on the lottery winnings in the form of annuity each year for 20 years. After 2 years of annuity payments, Lucky gives the remaining 18 years of payments to child. Gets taxed on that. Why? But keep in mind, what case do you have staring you in the face? A Giannini. Don't you have the Blair case, where if you give away the entirety of the interest, that the recipient should be taxed? I think there's a good argument, right, Galena, that the child should be taxed in this instance. Right?
How about the revenue ruling 69-102? Since, right, there was already, ripe fruit, doesn't it count?
Now, for your notes, it's not, I hear where you're coming from, Justin. There's a little tension between that revenue ruling and the Blair case. So I can see an argument in this case, not to try to make your notes ambiguous. I could see an argument both ways. But this has not been resolved. Why, and I'll say why. Most people, after the fact, it's too late to make the gift, because then if you look at Code Section 2501, there could be a major gift tax imposed. So that's why this case is, I'll say, unresolved for now, because most people who win lottery winnings, if they haven't assigned it prior to the lottery being drawn, they're not going to assign the right to their children. Right?
Is, for that question, it has the code section important at all? Because it's on our books.
That just says that if you elect annuity, you will not be taxed immediately per amount that you receive. Question 3, not the most important question here. Let me just give you a quick overview. Inventor develops a new electrical switch which he patents. Who is taxed on the proceeds of it of a subsequent sale if the patent is transferred gratuitously to son? So does the son have any income? Gets the patent? Oh, Jordan, you're supposed to say 102, no income. Okay, right? Takes a transfer basis, right, 1015. If the patent is transferred gratuitously to the son, who subsequently sells it to the buyer. Now, let's just assume the buyer was not waiting in the wings, unlike Susie Salvatore, who was sold a year or 10 years later. Who is taxed? The son? The mother? Son. Why? Because, now, here's why the authors are raising this with you. When you think of a patent, you think of someone performing services, right, to develop the patent. And we know under Lucas v. Earl that if you work hard, you should be taxed on the income you earn. You can't assign that income away. The author's point is, though, if you take your service income and you take it and you transform it into, in this case, an intangible property right, which is now property, right? It's an intangible property. You can circumvent Lucas because in this case, Lucas v. Earl, because in this case, you're absolutely right, Jordan. The son would be taxable. So effectively, you can thwart Lucas v. Earl by transforming your service income into some sort of intangible property right. How about an inventor transfers all of her interest in the patent buyer for a royalty contract, and then transfers the contract gratuitously to son prior to realizing any of the royalties? Okay? And once again, if you were to look at this 1959 case, what it holds is akin to Blair, is if the person gives up their entire interest, the son would be taxable. The son would be taxable. Whereas you might think the inventor who put in all the sweat into developing this invention should be taxed. Once again, transforming it into this royalty permits the assignment of income. So the authors are just illustrating that some of these principles, in some way, they're a little bit fuzzy along the edges, okay? All right, so in this chapter, keep in mind, it's bifurcated into two parts. Income from services, income from property, and you should use the right cases, the right kind of question, fact pattern. So just know that in advance, two very different kinds of cases at work here. And these are the kind of cases that you should know. Okay? You'll sound like you're really on top of the game. All right, so we skipped chapter 13. We moved to chapter 14, entitled Business Deduction. Now, keep in mind, I'll give you a cliche that works for me. I hope it works for you. Cliche is it takes money to make money, right? It takes money to make money. And what I mean by that is if you have an expenditure, say of $40, and you're spending that $40 to make $100, code says you should be able to deduct the $40 so that you get taxed on what? 60, right? Everyone agree? That the notion is you should not be taxed on gross income because gross amounts do not reflect your true accretion to wealth. Simple as that, right? And we spoke, I raised this to you, with you, that credits are generally more valuable, almost always more valuable than deduction, but let's not downplay deductions. Your clients are constantly will want to know what's deductible, right? What's deductible? And that being the case, let's turn to Code Section 162. Just like, guys, there's several important code sections that I try to call to your attention. Code Section 61, one that anyone who calls him or herself an accountant has to really have a good command over. Code Section 1001, computing gains and losses. Well, add to your list, but your list is obviously much, much longer than this. But certainly Code Section 162, right? Code Section 162, we're going to spend a class or two or three going through because it's that important. So let's look at it together for a moment, just to get our lay of the land. Code Section 162A, 1, 2, and 3 says there shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business, including. By the way, when you look at that language, we're going to unpack what do the words ordinary and necessary mean. That's critical, so you may want to circle that. Ordinary and necessary. Stating carrying on. What does the word carrying on mean? Then we have two terms of art that we're going to need further exploration. Ordinary and necessary and carrying on. We have 162A1, 2, and 3. Reasonable allowance for salaries and other compensation for personal services actually rendered. 162A2, traveling expenses, including amounts expended for meals and lodging, other than amounts which are lavish or extravagant under the circumstances. By away from home, you may want to circle the word home. You're going to learn that home doesn't mean what you may think it may mean. In the pursuit of a trade or business, and rentals or other payments required to be made as a condition to the continued use possession for purposes of the trade or business of property to which the taxpayer is not taking title to which he has no equity. So, when you go into Home Depot, Lowe's, whatever, you guys should go through a mental exercise this weekend. Think of having 3 different baskets. What are those 3 baskets of goods that you can purchase? 3 different goods, baskets. Again, Nellie?
In Home Depot?
Income.
In Home Depot? Where are we?
In Home Depot. Not at ShopRite. You're not.
No. In Home Depot, I get the plumbing supplies.
What do you use the plumbing supplies for? What? Plumbing. For your business? Okay. So what kind of, so you're in the business of repairing. So generally, what do you do with those purchases? You would deduct them against your income, right? Those are 162 expenses, right? But sometimes, Nellie, I would imagine you go to Home Depot and you pick up some sort of cleaner from the home, your home. Like, I don't know what kind of cleaner you use, but you probably pick up that or something for home use, right? Okay. If you do, what code section does it go on? Personal use items. Do not, but you have authority for that. Take a look at code section 262. General rule is except as otherwise expressed in this chapter, no deduction shall be allowed for personal living or family expense. So that's second basket. One basket is your personal expenses. Basket 2 is for your business expenses. What's basket 3, guys? Again, Wendy? I don't know how many people go to Home Depot for getting things for charitable donations. And what I had in mind here, Wendy, is suppose you want to make an improvement to your house or your business, okay? So you want to, you have a place of business and now you're going to add a kitchen to your place of business. That's called a capital improvement, right? You can't just deduct your capital improvement. What code section says that? Look at code section 263. No deduction shall be allowed for any amounts paid for new buildings or permanent improvements or betterments made to increase the value of any property or estate. Those are capital improvements, right? Those have to be capitalized and then, depending on their useful life, amortized over their useful life, or they don't have a useful life, they just sit on the books and records of the company or the business until the enterprise is sold. All right, so everyone, Nellie, have the visual, and I know you might say, gee, but I'm telling you, if you can frame these things, it helps. And we're talking about, we're changing. We looked at, right, guys, we looked at income. We looked at exemption. We looked at the character. We looked at who is taxed. Now we're getting to another important element in the landscape of tax world. What's deductible? And I'm saying it helps, I think, tremendously if you can conceptualize this as, hey, that's a personal expense. Ooh, disappear. Oh, that's an expense, supplies for your business, deductible. Or, hey, this is a major expenditure, we have to capitalize that cost. Right? So that's a useful framework to looking at the larger picture. So, over the weekend, again, do some of these mental exercises when going shopping. Make it 3 baskets, okay, guys? All right, page 311. This is what a day. You guys are being introduced to some of the most famous tax decisions ever rendered. This is your lucky Wednesday, maybe a hot Wednesday. This is your lucky Wednesday, all right? This is a decision that, again, most people in the world of tax will know. Wells v. Helbring. Who is it authored by? Justice Cardozo. Now, just people will have their favorite. I don't know if I do, but people will tell you that there's about 4 or 5 Supreme Court justices that generally rank above the rest. Okay, supposedly they were just super, super brilliant jurists. Suppose in that ranking, Justice Cardozo supposedly measures up, and Justice Brandeis. And there's reasons why there's schools named after these folks, because They were supposedly of a special caliber. I don't know if I agree or not agree, but I'm just sharing with you that these are some of the big hitters in our jurisprudence. Cardozo, Brandeis, Kansas Day O'Connor in Arizona has a school named after her. I think she was a good jurist. Obviously, I think her being the first woman on the Supreme Court helped propel law school. I think, but I'm not. There was a lot of controversy. There was a law school that was changing its name to Leah Law School. I forget which one in the South. I don't know if that actually stuck. There was so much controversy. But Justice Scalia was well known for being a very sharp writer, putting his politics aside, gifted writer, I should say. Okay, Welch v. Helbring. Remember, Mr. Helbring is all over the place, right? Oscar, your hands up. You want to tell us about this case? What happened?
The taxpayer, his company that he worked for, it went bankrupt. With another company.
All right, so the company he worked for went bankrupt, okay, leaving creditors stranded, okay? Everyone get the visual? That company goes bankrupt, creditors are not happy campers, and Oscar, he forms another company, right?
Well, he gets a job in another company.
I know, it's a new company, right?
Yeah.
New company. And what does he do?
Up to that he had under contract while he worked for the other.
Right, he decides that he's going to pay off the debt of the prior company. Now, does he do it because, say again, Oscar? Repairing credit. It's not because, now, he saw his priest or rabbi or imam, right? It's not like he had a religious revelation that he wasn't doing it for religious reasons, right? He wasn't doing it because even if he was atheist, he was just doing it because it's a goodwill gesture. He was doing it why, Oscar? Preparing credit and, say again, Jordan? Yeah, look, let's put a real word to this. We want to establish goodwill, right? And what better way to say, look, we don't owe you this money, but we're good for our word, and even though we don't owe you this money, we'll give you this money to, put us in best light, and hopefully you'll use our services, right? Now, is that the kind of thing that is often done in the business world? No, I mean, you know what I know. Many a company has declared bankruptcy, and when they do, I don't know if any of you, if it ever has happened to you, you get scarred from that experience, and you wonder. There was a place in Morristown that was a cooking school, and I thought at the time, this goes back several years ago, I would celebrate my wife's 30th birthday and get a class for she and her friends at cooking school. And they said, well, you can. It was very hopping. And I was, quote unquote, fortunate. The school was so hopping that I could get a place 5 weeks later for the class. And they asked for $1,000. I said, I'll just give $500. And they said, oh, okay. Anyway, did. 3 weeks later, I'm passing by, and it's all bordered up. And once that happens, that's it, game over. And I just thought to myself, well, it could have been worse. I could have given the $1,000. So now anyone asks, usually when people ask for deposits, yesteryear, sure, why not? Let me just pay it all up front, mentally, like I can check it off my list. But ever since that happened, I wonder, anyone else have a bad experience where you lost money to someone who went bankrupt? I mean, they were doing so well, they didn't know how to handle how well they were doing. And that it's it wasn't that they were doing poorly, they just couldn't handle their own success. And they apparently folded. So just be careful. You might say, gee, they're doing so well, it can be the exact opposite. So, no one else had a bad experience? I'm alone? All right. So I could do without that honor. So, Oscar, this was pretty unusual, right? So the question is, under Code Section 162, looking at deductible expenses, was this ordinary and necessary? Now, it was deemed to be let's look at some of the language here. They were deemed to be necessary. This is on the top, page 312, second full paragraph. They were necessary insofar as they were appropriate and helpful. But were they ordinary? They were deemed to be extraordinary, right? That this was not ordinary, that it was extraordinary. And as such, what happened to these expenditures, Oscar?
Well, you couldn't do section 2,
It couldn't be deducted. In fact, what ended up happening is approximately they had to be capitalized for Section 263. Now, the case doesn't make that clear, but that's the only takeaway. And since does goodwill have a useful life? No, right? Self-created goodwill cannot be written off. If you purchase a business with goodwill and you write it off, for GAAP purposes, you may not be able to, but for tax purposes, for GAAP purposes, no. Tax purposes, for Section 197, you can write it over 15 years. Right? But that's purchase goodwill. This is self-created goodwill. So this was held not to be deductible. And if you look on page 313, you look at the first footnote, page 313. So let's look at page 314. Taxpayer is a businessman, local politician, he's also an officer director of an S&L association, which he was a founder. And partially due to his mismanagement, the S&L begins to go under. He voluntarily donated nearly $500,000 to help bail it out. Is the payment deductible under 162? Or must it be capitalized under 263? Say again, Oscar?
The question again is whether that's ordinary.
Oh, is it deductible under one? In this case, guys, that's usually the issue. Not who, but rather, is it deductible, right? Is it deductible or must it be capitalized?
It's not.
Say it's not deductible. Why not? Well, here, your instincts, I think, are correct. You might say, gee, under Welch v. Helbring, these facts smell of familiarity, right? Everyone agree? Your instincts are to say it's not deductible. This taxpayer prevails. And I know that's counterintuitive. Taxpayer was able to prevail and say this was ordinary and necessary. And I think the main difference between this case and Welch v. Helbring is that this was an ongoing expense. In other words, this company had been in existence. Oscar, that's why I was calling to your attention. In the Welch case, that was a startup. And it had more of aroma. His payment as a startup expense, which we'll see under Code Section 195, startup expenses have to be capitalized. So I could see why a court could say under Welch v. Helbring that these have to be capitalized. So this is a tough case. Could have gone either way. But the court, because this was an existing company for many, many years, treated it like an ongoing expense under 162. Question 2. Consultant incurred ordinary and necessary expenses on a business trip for which he was entitled for reimbursement from client upon filing an expense report. However, consultant did not file the expense report and was not reimbursed, but instead deducted her costs on her income tax return. Now, this would, in today's day and age, be a miscellaneous itemized deduction, okay, under Code Section 67, which, under the current Tax Act, is suspended until the year 2026. But put that issue aside. If you're entitled to reimbursement and you have a $100 expenditure that you can get reimbursed from your client, and instead you deduct it, is it deductible, or will the IRS be allowed to disallow that expense? Which would you do, everyone in this room? Would you seek reimbursement, or would you take it on your tax return, or would you be indifferent? Irvine.
I would seek reimbursement from the client.
Why? Well, they owe you, but why not just take it as a deduction? Think about it. If you get, let's suppose the amount is $100. If your marginal tax rate is 37% and you get a deduction, you're only saving $37, right? That's going to essentially a $100 deduction entitles you. You can match it against taxable income. That will protect you against paying $37. If you can get a $100 reimbursement, you're getting paid the full $100 back, right? So it's like a credit, right? You would always seek to get reimbursed rather than to take a deduction. Particularly, again, in the year 2019, if you're an employee, it would be a miscellaneous, you couldn't even take the deduction. But again, let's sweep that issue under the rug. The fact you did not take a deduction suggests what? The fact you did not seek reimbursement suggests what? Yes, and maybe the expense is somewhat flimsy, as the client might disapprove of the expense, right? Because if it's a legitimate expense, wouldn't you say to your client, look, I incurred an additional fee for a notary or something legitimate, you say to the client, you have to reimburse me. But if you thought there was any illegitimacy to it, you might instead try to sweep it under the rug. Guess what? To the taxpayer, even if you didn't look at this case annotation, win or lose, taxpayer lost, right? Because the court said protocol would suggest that you would get reimbursement. The fact you sought to deduct rather than get reimbursement suggests the expense is not legitimate. But it's not ordinary and necessary. We're going to talk about expenses, what's deductible, and what's not. Okay, beginning on page 314, there's the notion of expenses versus those things that are capitalized. Now, this is not an easy exercise. Let me make that point clear. Because if you make an improvement, the notion being that if you add life to some property that extends beyond 1 year, it suggests that you should capitalize it, right? Because if you have an expenditure that increases a property's value, and an increase in value is going to extend beyond 1 year, it suggests, hey, you should capitalize that cost. So when you think about it, virtually every expense you incur, or your client incurs, is going to increase the usefulness of that property beyond 1 year. So when Nellie does plumbing work that improves the kitchen sink, okay? Improves the kitchen sink because somehow the sink is stuffed. And the easy example that you would think is, gee, a sink has a clog, call Nellie, and you incur a $100 expense. Everyone agree, deductible. But suppose Nellie says, look, I'm a plumber, you need to add a new pipe. If you get a new sink, it's going to be $1,000, but if you get a new pipe, it's $100, right? So now you added a pipe. Is that a capital improvement, or is that a repair that's immediately deductible? Or is that an improvement that you should capitalize now, deduct over the useful life of the sink? Like you say, Galena, very quickly, it's a repair. Why? Well, it does. If you didn't do it, the sink would be kind of worthless. You added real value, right? Irvine?
But the pipe could also be of a better quality, so you add value to the...
But now it's a better pipe because 20 years the pipe had lead, the older pipe, this is a better pipe. It has none of those issues. But I think all of us, Galena, your instincts are right. I think most of our clients and us would say it's a deductible expense. But I do want to share with you that virtually every repair has potentially the aroma of being an improvement that you would lead it to be capitalized, right? Because it is going to be, you hope that when Nellie puts in that pipe, it's going to last more than 1 year, right? And it's going to produce income for several years. And the fact that it produces income over several years suggests that maybe it should be capitalized and then depreciated over the useful life of that pipe. But, so you have to read this material, and this material is going to give you this notion of what is the difference between repairs and expenses, okay? Guys, and let me just call one or two things to your attention, and give me a few more minutes and then we'll call it a day, is that, look on page 315. Everyone say page 315. Notice the title there. Amounts paid to acquire or produce tangible property, okay, that's tangible property, versus page 325. Amounts paid to acquire or create intangible property. So we're going to see that there's a distinction between tangible and intangible property. And beginning on page 334, there's a discussion of carrying on business. What does carrying on mean? Okay, and where does that phraseology, carrying on, come from? If you look at the language of 162, it talks about ordinary and necessary, right? Why you are carrying on a trade or business. So we're going to have to ascertain whether or not the taxpayer is actually carrying on a trade or business. So again, what are the authors doing here? I want to remind you. They're unpackaging Code Section 162. They're first looking at ordinary and necessary. What are expenses? And then, what does carrying on mean? Now, is this going to shock you? I don't think it will. You see on page 343, notice the next heading here, specific business deduction. What the authors are going to do is look at Code Section 162, and again, unpackage it, and look at 162. Have it open, 162A. And we are going to spend some time looking at each one of these expenses, 162A1. Notice, reasonable allowance for salaries or other compensation. And then what the authors are going to do, I know it shouldn't surprise you, what do you think the next heading is, even if you haven't looked yet?
Traveling expenses?
Traveling expenses, right? So these things are all going to be things that, if you look at page 357, I told you the word home is going to be hard to define, but we're going to spend some time then looking at travel expenses. And if you were a gambler, what do you think the next section is? Rental expenses, page 376. Okay, so our objective is to unpackage the statute. We're going to look at the general language, then the specific language. Then towards the end of the chapter, guys, just to give you a little bit of foreshadowing, we're going to look at depreciation expenses, okay? Now, you guys covered it in GAAP, I'm sure. Fingers crossed. But now you're going to see it from the tax perspective. And do you think you're going to have broad latitude or narrow latitude when it comes to depreciating property? Broad or narrow?
Narrow.
Narrow. Okay, not your day. Very narrow. Okay, the code, we don't want taxpayers to be at liberty to take deductions as they see fit. So Code Section 168 is going to give us narrow deductions. Now, for next class, guys, I'm not exactly sure how far we will be. We will never, ever finish beyond travel expenses, okay? I don't know how far we'll get. Remember, next class is 3 hours, so I don't think we'll get I'm sure we will not get to page 376. How far we get in between, I'm not sure, but if you rent to page 376, we will get there. All right, so I will see everyone on Monday. Thanks for the elongated class, and have a good weekend in the meantime. Okay? All right. Thank you for joining us.